Incredible news from the housing market. We have got a full and comprehensive account of what is exactly going to happen to the housing market in 2023 from Harvard Joint Center of Housing Studies. We also have reports from RealPage, Globe Street, Fannie, Freddie, NAR, Case-Shiller, CBRE. We have our fingers on the pulse of the housing market right now. We know how fast it's going to beat, how healthy it's going to be in the future, and we finally have a handle on things from the Harvard Joint Center of Housing Studies. So strap in and get ready. Hi, and welcome back to the Gray Report. I'm your host, Matt Bosnagle, filling in for Spencer Gray this week. And I have brought with me an eminently capable co-host in Addison Lubert. He is our acquisitions and asset analyst, senior. That's a senior position. And he's going to share some of his insights with me. And I'm going to maybe less capably fill in for Spencer, but that's all right. I think that we've got a really great slate of articles and reports that are that will hopefully support any misgivings or shortcomings that I may have. However, I can't emphasize this enough. This Harvard Joint Center for Housing Studies, their State of the Nation's Housing in 2023 is a really excellent report, and I don't see any reason why we can't just jump into it right now. Comfortable?
Go for it.
All right. So this Harvard report now, and again, I apologize, there's not as much of a preamble as we have usually here, but this Harvard report is the State of the Nation's Housing in 2023, and it kind of characterizes a lot of the movements in the market that have happened in the past year. So a lot of what's happened in 2022 they kind of covered, and the status, what we're facing now, as well as what they think the outlook, at least for the near term in the future. Appropriately enough, they did signal the cooling markets for home buying and renting, according to the report. And I think it's more accurate to say, now they do call it cooling. I would definitely say it's more accurately cooled off than actively cooling. The month-over-month growth for both single-family prices and multifamily rents are much more positive than the year-over-year numbers would indicate. Actually, I almost made a social media post about this. The Case-Shiller Price Index reported its April numbers recently, and we'll get to that later in this episode. But these headlines are almost comically contradictory. Now you can kind of see here. We've got home prices increase again, signaling a recovery. That's from Yahoo Finance. And then the Wall Street Journal says, oh, no. U.S. home prices actually posted the first annual decline since 2012. If you look at Barron's, U.S. home prices fell. If you look at MarketWatch, home prices are rising. If you look at Scripps News, they have actually dropped. But then Bloomberg actually say that they recover. So which is it, Addison? Are they? I'm so confused.
I like to wrench that this report threw into all this kind of charcuterie board of options on the housing market. They had said that they said home prices fell.
Yeah,
but mortgages, like the cost of debt and everything, increased. So just because home prices fell, people still couldn't afford.
Yeah, they're still making higher payments, and that's a really good point. The amount of money that people are paying, that's higher. And even if it was even, now I will qualify it and say that the monthly numbers show growth. But when you look at the year-over-year numbers, that's you're including the real unambiguous slowdown that we experienced in the latter half of 2022 and the first month or so of this year. So yes, compared to last year, they are down. But if you do look at the monthly numbers, and we're going to go over that when we go over the Case-Shiller, it's actually above average month-over-month price growth for home prices, and they're only taking through April numbers, so maybe things have improved even since then. So we'll know that in a couple months. It also should be noted, and I'm back to kind of the Harvard Joint Center for Housing Studies report. Now, this source is not really writing to an audience of investors or from the perspective of multifamily owners. Affordability is a big concern. They talk a lot about, I think that one of their missions is to address these housing problems and try and figure out ways so that everyone can get housing. I don't think that they would disagree with me saying that that's one of their goals. So it does signal, with that in mind, it does signal the lack of affordability continuing for home buyers and renters alike. there is it doesn't matter that prices have gone down. It's still unaffordable, and from a historical level, they're elevated, plain and simple. So even though that it acknowledges as that homeowners gained equity over the past few years, um, there's still a challenge for people that maybe want to buy their first home, for people that are struggling to afford rent. These things haven't gone away. Well, not at least in like a meaningful way. So they're still kind of figuring that out, and they have a couple solutions or proposals, I guess. But it's still a huge problem that more or less defines the market. I think it continues to characterize the market.
Yeah, I mean, I'm going off the top of my head, trying to remember the exact specifics in the article.
Mm-hmm.
They started off by saying that the kind of painting a rosy picture of the housing market, but then when they break things down, it, I think, paints a more realistic picture than a lot of people probably assume is the case, and know or have a strong feeling that this is going to be the condition of the housing market moving forward.
Yeah.
The bulk of people that are homeowners are, the baby boomers and older generations.
Mm-hmm.
And they had said that while there's a little bit of a pickup with millennials, first-time home buyers, that's pretty positive. That's decreased. And we talked about how a lot of people now, it's almost starting to trickle into the apartment market, in the sense that you don't have as many people going out and buying an apartment, living on their own. The conditions of the last year or so has caused a lot of people to either stay at home with their family or double up, triple up in terms of roommates.
Yeah, I remember I talked to you earlier, maybe it was yesterday or this morning, and there is maybe an unspoken expectation that aging baby boomers maybe that will result in a housing surplus. But I don't think it's going to be so straightforward at all. I don't think that all of a sudden, all this huge chunk of the population is going to suddenly leave their houses empty and give them away for free to, beleaguered millennials. I don't think that's going to happen.
Well, and then going back to a report that was on this episode, I would probably say probably about a month or so back, I think the thing that a lot of experts overlook on when they make these reports is, I mean, for example, what you were showing, the previous headlines and the difference between them, whether home prices rise or they fall, there is still that issue that I had mentioned of, they fell, but if people can't afford to pay the mortgage, it doesn't matter how cheap you make the house. And on the flip side, housing price, I mean, you can drop mortgages like as we saw in 2020, 2021, but then you have a bunch of people that have the free cash that drive the home prices up.
Yeah.
And I think as we continue to see younger and younger generations come out of college, enter the workforce with large amounts of debt, whether that, I mean, more than likely being student loan debt, any sort of free money that they have, if they get it, is probably going to be, that I'd say previous generations were using out of college to make a purchase on their home.
Mm-hmm.
They're either not going to have that available cash, or it's going to go to, I would imagine, probably buying a car before buying a house. Yeah.
No, I think that's a good point. And I also think that, when it comes to housing demand in general, there are some demographic elements that they note. It's not just aging baby boomers, but there is a lack of, a kind of a low birth rate, really, such that they make this point a couple times in the report where immigration is pretty much the quote is, immigration has recently emerged as the primary source of population growth nationwide. Higher home prices are expected to make home ownership more difficult for large groups of the population, and the apartment market will have to be there to meet this consistent housing demand, like you said, especially with high interest rates. But again, like when we're talking about housing demand, it is going to be still elevated. I think, I'm not sure how much discussion there is about the broader demographic pressures. Now, this is, maybe the third or so major publication that I've seen to kind of note this impending issue of the kind of demographic. It's not a cliff, but it's not a great, it's not a great situation that we're in. And I'm going to be interested, and I'm always on the lookout for more of these longer term outlooks on, where are we going to go? And in housing demand, there is a shortage now, but I said this 3 years ago. What if we build so much to meet affordability, and then we overbuild, because then 10 years from now, there's not enough people to fill those. So it really just crashes. I don't think that that's going to happen, because builders are always kind of adapting to current situations and stuff. But it is it's becoming a little bit harder to predict. And that's another point that they make, is that immigration is so variable. And immigration has emerged as the primary population growth driver, not because we've suddenly become more permissive in terms of immigration or we're letting more people in. It's just that birth rates are getting lower, and this baby boomer generation is on the older side. So it's more likely that generation, which is so large, is going to shrink, and there's not a subsequent generation, especially of like household formation years, that is going to pick up that slack.
Well, the other, and this is pure speculation, I didn't think of this until I got in here, but one thing that I am wondering is when HOA fees really hit their stride, when they became a big widespread thing, because there's plenty of times where I think a lot of people definitely do it. You go on Zillow, look at homes that in a different life I'd own.
Oh, yeah.
But there's plenty of stuff even in Indianapolis where you could take a condo, for example. If you look at how much money it is in terms to purchase, and then how much money it is that you're going to be paying monthly on a mortgage, you're probably looking at it from that perspective, thinking, okay, I can stomach it, or at some point, maybe a few years down the line, I can pay for that. And then you see how much the HOA fee is, and it's like, I can pay the mortgage, I can pay the HOA fee. I can't pay both.
Yeah, you can see that. Look, I mean, this monthly mortgage payment, it seemed to have dipped a little bit, but it is it's trending upwards, which to me says that there is still a healthy demand. And that's another thing too. Maybe nominally the home prices have dipped a little bit, but if you look on a kind of an absolute basis, it's still pretty even. One thing, when it comes to kind of broader issues of housing demand, is that there's this interesting passage about remote work, and it's something that we covered last week on the Gray Report. But they say that looking to the future, one of the primary drivers of domestic migration, and in turn the geography of housing demand, will be remote work. And here trends are still evolving. Some workers are returning to the office, others are continuing to work from home, and still others are employing some combination of the two. Regardless, it is clear that the aging and growing diversity of the population, coupled with some workers' increasingly flexible work options, will change the shape of housing demand and necessitate housing adaptations. Now, I laughed a little when it said change, because that's kind of a cop-out. Either demand goes up or it goes down. I mean, maybe changing shape is fine, but when you get down to the when you get down, like, I want to know, are more people going to want homes or more people not going to want homes? I am thinking that remote work will lead to a longer term, especially if it persists, is going to support higher housing demand. I will say that things seem to be in the negotiation stage when it comes to working from home norms. There's not a settled status quo. There's still some bosses trying to reel people into work. But I wonder if unemployment goes up, if remote working becomes less prevalent due to workers having a little less leverage. But the final thing I'll say is, to call back to last episode, I said that I was looking for a couple of sources on the benefits of working in an office, and there were a couple actually, and I'll share them. I'll share them in the notes to this episode. But one was from Harvard, and there was another report as well that, again, I'll be chasing these down. But basically, it talked about the proximity effect, which is, you're gonna promote the guy that's around you probably than the guy that you see over a computer screen. All things considered, if they're exactly the same, I'd be 90. I'm gonna promote the guy that's there in person than over the screen. If everything else is the same, I think that's not. I don't even think it should be called proximity effect. It's just like, I react to my environment. If you're around, then I'm going to see, I'm going to perceive you more. I'm going to notice your accomplishments more than if someone is, working where I'm just not in the same room. We're not in the same building. I think it's a much more simple, and maybe even fundamental thing than a discrete proximity effect. I think it's just like organisms react to their environment. And if you're in that same environment, then you're going, then you probably will progress a little bit more quickly. But
well, I mean, you tend to favor people that you know and like, and you're going to know and like someone, well, maybe not necessarily like, but you're going to have more interactions with someone you're seeing every day versus someone that's across the country and you're only talking on meetings. I really wonder, though, where I kind of pause to get behind the whole work from home situation in terms of how it affects the housing market or how it's going to affect broader trends, because that didn't really seem to become a major issue until COVID, and after COVID and how people have gotten out of it in terms of going back to the office or how work policies have changed. I'm wondering moving forward for a lot of companies, especially if it's like a Deloitte or EY, where they're constantly getting a steady stream of new employees every year. I should say new employees out of college every year. How many places are setting the standards with their first kind of set of new people new to the workforce out of college? How many employers are saying like, no, you're in the office? Yeah, we can't convince the 40-year-old that's been working here forever to give up the whole remote status, but you don't know what the work environment is like. And this is like a huge, small companies are going to have to adapt or whatever, but some of the big name jobs, if you're Goldman Sachs, I'm sure the manager, whoever's making this decision at Goldman Sachs, has it in mind that there are plenty of people that will do this job in the office every day. If you don't want it, that's fine. I know for a fact I can find somebody.
Yeah. And that's what I, met when it kind of comes to leverage. Now I've read a few things about how, some employers are losing out on some talent because they're asking too much of them, or they're asking them to be in the office. And some people do think that's too much. I wonder, just kind of what you made me think about is, I wonder if these norms are, and I think they still are being kind of established, if it's a life stage thing where younger employees, they're not starting a family, they have less childcare responsibilities, they go to the office and they get those benefits of a faster career progression because they're in proximity. And then once they've established themselves, maybe they're a little bit more amenable, or you have a little more leverage to get remote work.
I also wonder what it does on wages, in the sense that, okay, you're not spending money on gas commuting to an office every day. And, the amount of people that, I don't know what the official numbers were, but you heard plenty of anecdotes of people leaving cities like LA or Chicago to live in, a smaller town or remote. I should say remote.
And that was one of the things they noted in this report too, was
people leaving LA, for instance, to live in Boise,
or just from LA downtown to LA cheaper suburbs.
How many places are saying, okay, you're not in LA, I'm not paying you a Los Angeles salary anymore.
Yeah, and I definitely think that that's happening. And just to kind of to bring it back to housing and multifamily, I think that this will make homes more valuable because you're doing more in them than eating, sleeping, and living. You're also working, and working's living, but you're performing more functions than, and whether that means you're paying for an additional home office, or whether it just leads to more household growth. I think that it has a net effect of increasing housing demand, and depending on how dramatic this persistent, how much remote working persists, then I think it could have a significant effect on housing demand going forward. Maybe I don't think it will counteract the demographic uphill battle that we've got, but it will certainly support higher housing demand in the near term.
The tough part that I have getting behind a lot of this stuff, in terms of a lot of the different housing forecasts and everything moving forward, is I still think too many people are looking at it from, okay, the kind of like going back to what we had started off this talk with, about the report of boomers dying off, and now you have a bunch of millennials, Gen Zs, that at that point are going to be looking for homes. The interest in owning a home going down from generation to generation, I don't think has changed. I don't think millennials or Gen Zs or whatever the generation is after me is just intrinsically not interested in owning a home. It's free, I shouldn't say free money, but available money to use to pay off it.
Yeah.
And people are looking at it of, okay, well, mortgages are down or housing prices have gone down or some combination of the two. That's going to cause them to want to buy homes and take up the supply without factoring in that, okay, they can do that, but can they afford the tax bill?
Yeah.
Can they afford to live in an area that radically, through gentrification or whatever, assessments go way up on them? They're out of it.
Yeah. Yeah.
Okay, they can afford the home, but $1,000 garage door repair, can they afford that? Can they afford to do the landscaping? There's just, I feel like there's a lot that is being overlooked of the lack of, I mean, now we're seeing some real wage growth for the first time in a while, but I don't think that that's going to be a stable, consistent thing moving forward.
Yeah.
And so it's one of those things of, okay, you can continue to look at the housing supply, but if the folks that are going to be filling that supply can't afford all realms of home buying.
Yeah. No, and that's true, especially in a high interest rate environment. You're taking out that expensive mortgage. You are considering all the repairs you might have to have. It doesn't look like a great investment. And actually, they do talk about investment activity in the single family home market, and they call it strong. Or they say it's going down, but it's still strong. I think that's a little weird because investor demand has softened and it is around historical norms. So I don't think that investor demand or investor ownership of single family homes is really driving the market. I think what is happening right now is hugely just a product of high mortgage rates, such that, like, if there was ever an argument that homes aren't a great investment, I think now would really be a time to say that. Because you're paying a lot you're paying a lot every month. Any fix that you're going to have in your home, that's not like suddenly cheaper. And there's a lot of there's a lot of negatives. I don't think, and the price appreciation, it's not really there right now. And so there's a lot of reasons why you may just put your money somewhere else, even if you have it.
Well, and yeah, I could say it over and over again. People need to stop viewing a home purchase as an investment unless they're renting it out to someone or they're renting it out to a roommate. Just buying a house for yourself or your family to live in, you're going to lose money on it.
Yeah. Yeah.
Unless just a rapid appreciation of the area effects. But I still don't know why people are looking at it like it's an investment, because it's not. You're making a purchase on it just like any other other situation, and it's not.
Yeah.
You're not going to make money on it, and they should stop viewing it as that.
So kind of moving along to production in this report, they talk about single family construction, as a product of this lower demand or higher mortgage. It's very understandable that single family production is slowing, but they also note that multifamily is high, multifamily is active, or as it says, thriving. Now, I'm not sure if thriving again is the right word here, just how strong it may not have been the right word to use to describe single family home investment. However, yes, apartment building activity is going on, but I think that's more of a product of the backlog of construction over the past 3 years. And we're still working on that. We're still working through all of those delays and labor shortages. Now, they happened a long time ago and they're probably a lot better than they used to be, but that doesn't eliminate the projects that still have to be completed.
Yeah.
Apartment buildings take a lot longer to permit, plan, and build, and so we're still really working through that. I don't think that apartment builders have been taking on a lot of new projects in this high interest rate environment. And but that being said, there is a lot of supply coming online in a lot of what used to be high growth markets, and there's still high growth, but the increase in apartment supply is really changing the character of a lot of these multifamily markets. I still don't think that would mean that builders are going gangbusters right now and taking on a whole lot of new products. So I just wanted to kind of qualify that. So to kind of wrap things up, they ask, or at least they provide a little bit of an outlook on how to address these affordability challenges, really, how to get more of the houses that people need if we're not building single family homes. If, like I think too, we're going to have that gap in a couple years where multifamily is going to go or multifamily supply is going to dip down because, we didn't build now for 2 years from now. So they say that, yes, building lower cost housing is important, just kind of giving money and to people to build those. But they also highlight the need for zoning reform to allow for more houses of all types, not just affordable housing. And I think that it is worth noting that, you build houses of any type, that will reduce housing prices. Now, it's not going to have as direct an effect as if you build that targeted house to that targeted population, but more houses, more supply in general, will push houses down in the aggregate. Again, not perfect, but it's still a solution that needs to happen. Also, they're calling for subsidies that would incentivize apartment builders to build affordable housing instead of luxury or like high-end apartment products. It's kind of a frustrating bind that we're in. The more affordable apartments are typically the older ones, and just like waiting for apartments to get old is not really a practical way to get more affordable housing. So I think that I think nothing for as dramatic as it has been in the past year, from June of 2022 to June of 2023, or really now into July. The path has been pretty linear. Interest rates went up, housing demand went down, but the demand is still there, and you could see so many signs of it kind of bubbling under the surface. And my impression, at least, is that, if interest rates go down, or really maybe even if they stay stable, people will start to think about buying a house, or I hope, buying an apartment, or maybe even selling their house, because that's one of the things that they note as well is part of this housing affordability crisis, or this housing shortage, is because people are not selling them, and they're not putting their houses on the market like they would in normal circumstances.
Well, likewise, going back to what I was saying with kind of my pessimism of, okay, if the older generations die off and there could be a lot of supply. I mean, if it's that drastic, then I think we could see that opportunity. But
yeah,
I can't see it being too drastic where the supply gets so big that prices drop dramatically.
Yeah.
And I don't know. I mean,
in select markets, I think that that could happen. I think that what has happened in the past, and I note this a little bit later, is what has happened is housing demand, or at least apartment demand, has softened enough where it's not like you can just pour in apartments anywhere and people will run and fill them. There's beginning to be a cause and effect. I think that's normal, but it's not. I don't think we're anywhere, and I don't think we're in a cool down situation like we were really in the latter half of 2022.
And likewise, when they talk about the new construction happening and it's going to higher end apartments, unless they change, and who knows, maybe that's a part of the zoning reform that they're trying to go after, but it makes sense that if you're going to take on the high cost of construction, you're going to build a product that gets you the most amount of money.
Yeah.
And so I think that's how it's going to be for quite a while, unless there's major reform in the sense that, hey, there's only a certain amount of money you can charge. If they do a lot of stuff that we're seeing here in Indianapolis, where you can only have rents or raise rents to a certain percentage of the neighborhood income.
Yeah.
But that's probably going to require a lot of subsidies or, tax breaks, whatever, to get that development started. And it's going to be a massive undertaking at city, state, and potentially even federal levels to get that to happen. And I don't see enough organization behind the scenes to make that push, to make it happen, and make it happen to make it as impactful enough that we really see a change in the numbers, such that more people, there's more supply, rents are going down, people have more disposable income, or it moves the needle in that more and more people are able to afford homes now. I can't see that being a realistic possibility within the next. Can't see it being a possibility.
That's what I was wondering, is like, what would a successful business model of a builder be that only builds affordable housing? And maybe there is one out there, and I wouldn't blame it, because it's a righteous mission. You are solving one of the biggest and most important problems in society right now. But that would mean sacrificing probably like profit margin, or maybe it means the business doesn't make sense because you can't pay people to do it, short of having government subsidies. I think that the fact that it's there is difficulties that I don't think people are, there's not a bunch of companies already that do that.
Mhm.
And so that's probably why they're calling on all of these solutions. And I think that zoning, even if the money and the numbers make sense, if you have a bad zoning and, if your zoning's not right, then you can't build no matter how much money you have. It's an uphill battle. So there's a lot of different angles where things could go wrong, and you just have to be pressing every step of the way, I think, to really solve this problem. Because no one, there is NIMBYism is it's almost like a human nature. It's more likely than not that people are going to say not in my backyard than they're going to want housing in their backyard.
But at the same time, you and I have poked a lot of fun at the stuff we see on the Indianapolis subreddit anytime a new project is announced. As much as that stuff is going towards higher end rents, basic supply and demand is still gonna take hold.
Yeah, people will build exactly. And if there is demand high enough, they'll push through and they'll build those apartments for sure.
Well, also, I mean, even if all you're doing is adding new high end apartments, there's going to be a shift somewhat. And again, I don't think it's going to be too impactful.
That's a good point. Yeah.
Supply is never not a bad thing.
Yep. I agree. All right. So
Never a bad thing, I should say.
moving on to a kind of a more broader economic assessment here from Fannie Mae. They say mixed data muddles macroeconomic forecast. Part of the reason that I picked that was because that title had so many M words I really liked. Mixed data muddles macroeconomic, well, whatever. I'm sure, again, right when Fannie Mae is, at least in our experience, and this has happened multiple times, where they have had an economic outlook that is negative. And it was negative this month. Fannie Mae is usually glass half empty about the economy. And here's a passage that really encapsulates what their take is here. Now they say, we expect, now let me scroll down to, there we go. Let me just highlight it here. We expect the continued tightening of credit conditions, slowing bank lending, and shrinking money supply will eventually lead to a downturn in business investment and hiring, eventually leading consumers to pull back on spending, coinciding with a recession. They're pretty sure of the recession. They think it probably will happen. I'll try to find some optimistic projections to counter this, and I think I actually have had one. Here, I'll pull it up here really quick. This headline says that, is it time to cancel the recession altogether? And I like the I like the other headline that they have on offer here is recession 2023 might be canceled, but economists won't admit it. Here, let me show you that. So it's not a sure thing, is it? I mean, this is a Bloomberg article. Now, maybe this is the contrarian, kind of clickbait. But it's not quite so sure that we're going to have as huge of a downturn as some of these projections. Now, I'm skipping around and it's okay because the following report on CBRE, they talk about multifamily vacancy poised to rise. Their expectation of recession, they call for a moderate recession. And, I was kind of looking for formal definitions, and the Fed's defined it, at least they have defined it before. This moderate recession means an increase in the unemployment rate by 1.25 to 2.5, which is to say that it's not a mild recession. That's a degree above, or maybe one below severe recession. So moderate is, you'll know you're in it. It's not just like, oh, is this a cool down, or it's not, because a lot of people have said, we'll be on the edge. Maybe it won't technically be a recession, but CBRE says, we'll know it. And back to Fannie Mae, but they, Fannie Mae does not really address the strong labor market as accurately or as specifically. I think that they have a tendency, to kind of downplay the labor market strength that we're seeing, and they do make a good point. Now I'll bring up the Fannie Mae back again here. If you look at the chart of, now they use, this is a Kansas City Federal Reserve labor market conditions index. So it's not like a typical unemployment or employment rate. There's probably some factors that they use and some things that they adjust. But if you look at the graph here, the labor market really peaked probably around the beginning of 2022. and it has been steadily going down. Now it's still very elevated on absolute terms, but the trend line is going down. Looking at that trend line going down, you may forget that we had really strong jobs numbers for the past couple of months and like some great momentum. I think that there is a lot of things out there that show that the labor market is very strong, but it is worth thinking about the larger trends that may be happening. Maybe, we're only looking at now, and if we look in the future and look how things are going, things are sliding off. And certainly, stories about tech layoffs and, general uncertainty and a high interest rate environment would suggest that employment is going to be affected. I am continually puzzled by the strength of the labor market right now, just because of all this stuff that we're hearing about. All this thoughts of recession, all this uncertainty. I wouldn't think that people would want to hire if they were so uncertain about the economy. But hiring they are.
Well, I think the last decade, especially the last probably 3 years since COVID, it's really confusing a lot of the people that have done these projections or have kind of had it's really made a dent in conventional wisdom in terms of unemployment and the labor market and just broader macroeconomic thinking.
Mm-hmm.
Yeah, I remember taking macroeconomics, and even at that point, they were still, it was 2017. They're pushing the whole, there's an ideal level of employment or max level of employment that we could have. And you really don't want unemployment to get below 5%.
Yeah.
There's going to be chaos if that happens.
Yeah.
We proved any year after that you can have 3% unemployment. The economy does okay.
Yeah. Yeah.
You can have, I don't think ever will get to 2 or 1%, but
now
there's that combination of it. And I think we've seen a lot of it with more so through the Fed than anything, treating inflation that we've seen post-COVID like inflation that we've seen in any other cycle of the economy or any other time in the past. There's been labor shortage issues with labor shortages, mainly supply chain issues. And you also had an entire year of inactivity in a lot of markets where, say, if you're in Chicago or New York or LA during COVID, you weren't going to bars, you weren't going to restaurants.
Yeah.
A lot of people weren't doing anything and they were holding their money.
Yeah.
They now have that money to spend. I think there's a lot of stuff that is being factored into kind of the broader macroeconomic forecasts or the outlook moving forward. And it's using conventional wisdom from whatever happened in the 70s or the 80s or the 90s.
Yeah.
And they're not taking a look at, okay, what's going on right now? What caused the inflation that we've seen the past 2 years? Is that any different than what we have seen? Because I think it is.
Yes. Yeah. That's a good point.
I think that's why they continue to be baffled when they raise interest rates or they take certain measures and you continue to see jobs added.
Yeah. Because we're still transitioning and you need worker and maybe, some of these workers, some of these places that are hiring, maybe it's a bar or a restaurant or a retailer. They are a lot of service industry jobs are maybe less connected to interest rate hikes than they are to really consumer confidence.
Right.
And for the past maybe month or 2 or 3, I don't know, things have slightly improved when it comes to consumer confidence and credit. Now we're still at a worrying spot when it comes to consumer credit. Like we've got a little too much of it. Maybe we got a little too less savings than we should have. Maybe, but things aren't continuing to crash. Now, just to bring up this chart again, it's a question of, is this gonna there's a steep fall off from 2007 to 2010 in the employment numbers. But if you look back to 2000 to 2003, there was a little bit more of a mild. And so what kind of trajectory is this going to take? And I do think, you talked about the last 10 years and the assumptions. I think, since this low point, since 2010, we've or really 2008, we've had such a pessimistic view of jobs, and that's really crept into people's psychology and the way that they understand how the economy works. it has certainly shaped forecasts. And I am not going to say that things are going to be better, but I think that there's a lot less certainty. And in this case, uncertainty may be a little bit better when the alternative is a certain doom. But that's just my own take.
And I can only speak to what our line of work is, what we're seeing internally. But when you see massive expense growth in areas that you can't necessarily control, right? You've seen insurance payments go up, or you've seen payroll go up because the hourly wage that maybe a maintenance tech or a property manager, whatever it is, it's gone up because that's just what the market is right now.
Yeah.
It hasn't necessarily led to, okay, we got to lay off or we got to get rid of people, but it's definitely led to, okay, do we need to change our assumptions moving forward from an underwriting perspective?
Yeah.
Is this just the new reality? But also, let's take a deeper look inside as to how are we spending our money, and is it the most effective way? It's causing a pause. It's causing some time for reflection.
Yeah.
I have no reason to believe that that's not going on in every other financial decision-making realm of any other company.
Yeah.
So how much of this is recession versus people saying, okay, we had to ramp up costs. We had to ramp up whatever from 2021 and 2022 to get back to where we were had COVID not happened. Now we need to make sense of where we're at.
Yeah. No, I agree completely. I'd like to move on just to some more general. Now we talked about the economy. Now I want to talk a little bit about housing demand. And we have a collection of articles here from Freddie Mac and NAR, as well as Case-Shiller. And I'll start here with the Freddie Mac housing sentiment, in the second quarter of 2023. Now, this is just some headline numbers, so it's not really a huge research report. Yeah, so this Freddie Mac housing sentiment report, really just kind of the results of their data. They surveyed about 1,100 people, and they came up with this figure. The housing sentiment, these are the percent of people who are extremely or somewhat confident in the housing market going forward. And this quarter, Q2 of 2023, 43% think that the housing market will remain strong over the next year. That is stable from last quarter that also had 43%. Now, the previous quarter, so Q4 2022, we were much lower. I'm not sure if they have that number, but I just see it on the line graph. You can see it's obviously okay. So in Q4 2022, I got to do the math really quick. 35%. Is that right? 43 minus 8, yes, is 35.
Nice.
I know. I'm not even good at math. And I did that myself. All right. But yes, now you can see the embarrassment on my face here. The upshot to all of this is that things are stable. I think this is like a stable uncertainty that we've experienced throughout the year of 2023. I think that there are maybe some signs that things are picking up, but not really evident from this glimpse of housing sentiment from Freddie Mac. And it completely, I understand that mortgage rates are high. No one's putting their homes on their market. Less people are building homes. It's not great. It's not a great situation to be in right now. It is interesting if you look at that. It is the times when housing was roaring, when prices were going up so much, people were really confident, and then interest rates go up and people become less confident. It is as sure of a cause and effect as you can see.
It's the housing market being strong, like these types of polling or surveys.
It's a really general question to ask too. Like, in what way?
Yeah, I was about to say, because it reminds me a lot of when, like in politics, they ask the right track, wrong track question.
Yeah.
And they'll say, majority of the country thinks majority of people think the country's headed on the wrong track, without thinking. You could poll a Democrat, you could poll a Republican, and you could poll an independent and ask them whether they think the country's on the right track, wrong track question.
Mm-hmm.
All three of them could say the wrong track for entirely different reasons.
Yeah.
And so taking that into this, when you say strong, is it the sense that, okay, well, I don't think if I'm living in Newport Beach, California, I think the housing market's strong because I don't think the value of my house is just going to bottom out at any point in time. Okay. But I really wonder what they mean by strong and what that is supposed to mean moving forward.
Yeah, no, I think that's a really good point. If anything, you looking at the trend, you can correlate it to kind of improving or decreasing, increasing or decreasing home prices, but it's more useful when you're kind of pairing it with more discrete and measurable piece of data, and one of which,
like, I think a more meaningful study would be how many 20-year-olds think that they're going to be able to buy a house in 20 years. Something like that. Granted, I can understand when they say they think the housing market's strong. Okay, I can get that compared to, say, like office, where a lot of people have determined they don't need a use for an office anymore, despite the fact that I don't think anyone's ever going to say that they don't need a home.
No, I agree.
A place to live.
Yeah. Now, skipping ahead to CoreLogic, they do have, this is more of a measurable way of figuring out where the housing market's going. Is home prices. Now, these are April numbers, so things have almost certainly changed in May and also in June. But they have it at a small annual decline, down by 2% in April. Now, need I remind you of this wonderful picture that I made and I almost posted on the Great Capital social media last night? Some people see this annual increase or the annual decrease, and some people are looking at a monthly increase. It depends on what point you want to make. I also think that you can think about both of them. The annual decrease is a product of the whole year. And the monthly decrease, if you're kind of looking for the future, I think it's worth looking at the past few months instead of just looking at the whole year. That's just me. But one thing to note is that if you're looking at these monthly increases, we are at slightly above average. Now, I'll show you this here. Now, let's put it in picture. See, the line for April 2023 is this blue line that is reasonably above the price growth from 2015 to 2019, really even including 2020. It's only in 2021 and 2022 where Aprils were as expensive as they were where April home price growth was as strong as it was this year. So I think that we are, if you look at that now, the steadiness, maybe, it's not increasing, it's steady, but if home price growth remains steady throughout the summer, then it will still be above average, because we are above peak home price growth on a month-to-month level. We're right there. And so I think that's very promising, and it's something that you can't really see if you only look at the annual numbers. Now, just to fly through this, now the NAR, National Association of Realtors, had a similar kind of a sentiment. Now they call it confidence. It is well in line, I think, with general housing sentiment and well in line with the price growth. But it's good to have a little bit more perspective here. So with supply still limited relative to demand, 31% of homes sold above list price, down slightly from 33% last month, but down 55% a year ago. So a little less than a third of homes are sold above list. Now, compare that to 55. The comparison is what's really crazy. 74% of these realtor respondents reported that properties sold in less than 1 month, essentially flat from a month ago and down from 88% in May 2022. Homes got an average of 3.3 offers, which is up slightly from last month, but down from 4.2 offers in May 2022. First-time home buyers is essentially flat from actually last month and a year ago. And 25% of buyers had all cash sales, which is down from 28% last month and unchanged from last year. So still the same amount of cash buyers. Confidence in general, whether you're talking housing sentiment or housing confidence, it's easier when you have this report of, okay, how long has it remained on the market? How many bids has it? How many is over, is under? I think that those are more practical than seeing like, how do you feel? Like, well, what if you get an optimistic guy? You know what? I always feel good about everything. I have a thing, that's I can't make an investment based on that.
Well, yeah, and it's interesting to get some data on people that are in the market. They're either selling or buying, as opposed to someone that's like, yeah, I feel extremely strong and optimistic about the housing market.
Yeah. Now I did looking into the detail of those. Looking at the detail of those, it did say like average time of that a house is on the market, and it was almost 30 days, like across the board. And I wonder, like, I don't know. I'm very curious about the consistency of that 30 days. Wow. Maybe they take it off after 30 no matter what, but I don't know. That is really all that I have to cover with you, Addison. I don't know if there's any kind of final thoughts that you have about the economy, about housing, about the apartment market, or anything that I missed, anything that I got wrong. Here's your chance. Otherwise, you'll never be able to get this back.
Yeah. No, I mean, a lot of ways, I think it's just seems to be kind of from the last time you and I were on here, seems to be kind of a constant stream of heavily worded articles basically saying, we don't know what to make of this, or things look like they're going back to normal.
Yeah. And that's what we're kind of trying to do here. And even just by virtue of saying the same thing week after week, or feeling like we say the same thing week after week, you can go back into previous episodes and you could see the trends as they form. You could see people getting nervous and calling for doom in July of 2022. And the fact that has repeated, well, guess what? Did not happen in the last year. Doom didn't happen. Now it could happen maybe in August of this year, maybe in November. Maybe they will get that recession that they had pegged. But as much as things haven't changed, some of the predictions that people have made haven't exactly come true. And so I think that's what's really interesting about this.
Wait, hold on. You're not talking about Jim Cramer, are you?
No. Jim Cramer is never wrong. You heard that right.
I mean, because I'm thinking about it from a lot of the articles that I'll see or that are kind of circulated around the office in terms of different owner-operators that are struggling through this. And what we're finding is kind of similar to home buying in the sense that the fundamentals of home ownership or wanting to own a home haven't changed. People still want to do it. People still see a need for it. In the same way it is with multifamily investment. It's not that it's gotten worse. It's just the real crisis that's coming forth isn't that the overall market is bottoming out. It's the fact that you had a lot of people that put on floating rate debt and made some either ridiculous rent assumptions or didn't at all see expenses jumping. And so they're having issues because they're not meeting projections. And so it seems like there's kind of this artificial panic going on in the sense that rent growth is slowed. Rent growth isn't where we need it to be. Well, because you forecasted it at 20% for some reason, you're only getting 5%. To someone who wasn't as aggressive, or to someone that, I mean, a lot of times it's more of a situation of maybe a New York or LA group investing in a Des Moines, Iowa complex. And so owner-operators in Iowa knew that, okay, rent can only go up so much, or this is where rents are at, whereas New York or LA bought into some other narrative. There's that level of, or sorry, not that level, but there's that gap in between panic and optimism. So I don't know. To me, it seems like, kind of in summary, it seems like a lot of things are going back to normal. And a lot of people that didn't bet on that or thought things were just going to continue some awesome rent growth streak of 19% year over year. They're the ones hurting because
normal looks pretty bad when you're comparing it to great times.
Exactly. And I'm hoping that this kind of filters out, that people are going back to 2018 or 2019 expectations. I don't entirely know what those were because I was still in college, but I think enough of those stories, enough of those headlines, and kind of the rapid change from what was going on in 2021 and 2022 is sounding a rather pessimistic alarm when things are just going back to where they were 4 or 5 years ago. That's not necessarily a bad thing.
I just keep thinking about what the cost benefit is, or what you lose by listening. But what if you did listen to the doomsayer that was saying that doomsday is going to hit? You know, they said it in August of last year. What if you listened to him and you liquidated everything? What did you lose? You know, by not having faith in the, or even if it was just not, you know, even if it was in this uncertain times, it wasn't necessarily boom times, but it wasn't doomsday. What do you lose by listening to someone's pessimistic take on the economy that doesn't come true? Now they'll say, yeah, well, isn't it good that it didn't go down? I mean, aren't you glad? But like, no, you probably did lose something because you thought the economy was going to be worse, or at least you lost the opportunity to grow.
But I think this kind of speaks to a broader issue, and it's only going to get worse as social media expands, and there becomes more and more talking heads on various items. But that's largely the problem that I have with kind of the Dave Ramsey's or the Robert Kiyosaki, the Rich Dad Poor Dad guy. Not everything is black and white.
Yeah.
And what I think a lot of people lose focus of is it really shouldn't matter if now is the right time to buy a home or not. If you're in the market to buy a home, you can afford the down payment. You feel like you can afford the upkeep of it. Most importantly, you can afford the mortgage.
Yeah.
Then buy a home. If you can afford a brand new car, then go get a brand new car.
Yeah.
It's when you can't afford those things and you still do it anyway, that's where the real problem is. And so, yeah, I just...
There's personal doomsday and then there's economic doomsday. And sometimes it's hard to tell the difference.
Yeah.
Yeah. Well, thank you. Thank you for coming along. In just a second here, I'm going to have Katrina Green. She is the Director of Property Management at Great Capital. She's going to offer a little bit more of an on-the-ground perspective of what's happening in the multifamily market, as opposed to this bird's eye view from the eminently capable and eminently tall Addison Lewert. Sorry, I didn't mean that. I didn't mean to insult your height.
The camera adds 3 feet.
It's good. Nice. Thanks, Addison.
Hey.
Hi, Katrina. I am I'm Bob Michael, and I am the host, and it is great to have you here. Great to have you as a guest. We do know each other. This isn't the first time I've met you, although it is the first time. No, actually, the second time that you've been on a podcast with us. You recorded already a kind of introduction episode, and we will be releasing that soon. And you have an upcoming podcast that we're really excited about, and we're kind of getting everything together. I'm getting really great artwork, and I'm excited about it too.
Wow!
So
I feel famous already. Thank you.
Well, that's right. You even more famous than you already are. The famous Katrina Green is here to tell us about a little bit about like operations, and I've got a lot of questions that probably will be easily answered, but it's stuff that I've always really been interested in, and it kind of connects with some of these trends that I hear about what's happening with leasing traffic and what's happening with expenses, with how, and Addison said this before about, you know, how a lot of operators, a lot of owners are seeing rising expenses, rising payrolls. Some of them have been able to figure it out, but others, they thought that they'd have 20% rent growth this year, and now they're kind of hosed. So
I don't. Yeah. Absolutely not.
So going in,
100%.
So I want, you know, it's part of it probably is like making sure that you have reasonable expectations and not setting your expectations too high. But I think that there is a lot, and this is one of the reasons why I really was excited to have you, is like, it's gonna have experience and knowing, okay, this is a weird thing that's happening. It's only going to be 1 year, or, you know, this is usually how I solve this problem. But
yeah.
I think that there's
I mean, that's the beauty of, 20 plus years in the industry. And I'm not saying that we don't have things that surprise us by any means, but I've been through cycles.
Yeah.
And, we've now I can't say that I've been through a cycle where we had 20% rent growth consistently and, continued to watch. I mean, we were capping renewal increases at some of these sites at 20% and 25% because we were just like, gosh, when does it stop? So we were capitalized on it when it was occurring, but it turns out we should have been stockpiling that revenue in preparation for the, I guess, congruent expense issues that we're seeing and those increases. As fast as we received it, we've spent it.
Yeah, no, that's and that's what's really interesting too. And well, one of the questions that I have, and I'll just jump into it, is like, what I asked you this before, is like, where are the areas where it's been like an easy solve for some of these expenses costs? Is like which areas have been easy?
Yeah.
It seems like you've just got a whole lot of big problems. And
yeah, almost nowhere. I actually, after you asked me that earlier today, I just pulled up a budget and I thought I'm just going to go line by line in these account codes and which of these things has felt, fixed or felt like we actually had a place to reduce. And, it's silly things. It's not big money. It's like office supplies and, areas where digitizing those processes, we're not buying as much paper and, but that's not big money. So if we're really going to talk about controlled expenses, it's really, it's a mitigation, not a control. We're not in control necessarily. We've never been in control. I mean, there are some fundamental things that are essential for us to run it. And, not a lot of that do you get this like moment of decision making. Well, will this person work today or will they not? No, like you can't. It doesn't work that way. So in the payroll side, someone at NAA said to me, he said, well, we've been operating really slim all along. So, is it that all the tools that are coming up, is it that it's really reducing our payroll cost, or is it just that it's, finally fulfilling and backfilling, some of the work that was being done?
Yeah.
I was like, well, I mean, that was one way to put it. But mitigate.
Yeah.
We are doing things to mitigate our expenses.
How much have you had to make those decisions where one person maybe has to do like 1.2 people's jobs? Or is that kind of always the case where you're always, you're always just trying to push as much as, work as hard as you can expect. But man, it just seems like, especially on the labor side, it would be as such a significant portion. And, some people just by default do more work than other people. Absolutely. And so, I wonder how much of that can be solved in the hiring, on the hiring side, but also like, you can't exactly tell people, okay, today you're going to work harder.
Yeah.
It's a little harder to do. It's
really hard to do. And I tend to steer away from talking about, humans. And it's not because I don't absolutely love humans. I mean, I'm a like a golden retriever. I want to talk to everyone and I want to make friends everywhere. But, we're just talking about the work. At the end of the day, it's about work getting done. And it's not, who's doing its labor and its labor alternatives. And some of those labor alternatives are contractors and some of those labor alternatives are software. But it can get out of hand quickly. We could buy so much tech.
Yeah.
And then, and you could be at that position where you're just like, wow, we've already invested in all of this, but we also still have to invest in, this one person for these tasks or whatever that looks like, and we're probably pretty far away from gig work, from that leasing environment being more like a real estate person where they're just, creating appointments and making appointments and coming in and just getting commission almost like a realtor.
Yeah.
Maybe we're going to get there. Maybe it would be smart.
Is that what the discussions are?
I mean, I've talked about it with my staff for many, many years.
That's interesting. Yeah.
Just because like the earning capacity of a really strong salesperson then could grow exponentially. And when you think about market knowledge, the harder part is, if you have a portfolio where the geography works and you have lots of properties in one place, then that's great. But it would be hard to start, understanding like, will the person do the same work for your community as your sister, or not a sister community, as a competing community? Like, is it a bid war for commissions? Do we say, come to us, I'll pay you $800 for every lease, but I'm not going to pay you $1 of, hourly time. But if they work that lead and they close it and they use all that tech and they make all that money, maybe someday. That was way.
That's interesting, and I'm going to follow up on that when I talk about like leasing traffic and stuff. There's another article that's coming up, but But on the expense side, so we've established that there's no like great road, there's no sunny side necessarily, and maybe expenses have increased across the board. Is there an area where it's like, wow, like the expensive increase the most?
Yeah, there are a few areas, there are some that it's about a cost increase, and then there are some that it's about a cost increase and a value decrease.
So, okay.
Like things we don't like to talk about, like landscaping and trash, just the general, how does our property look and feel when you come on it? On the landscaping side, those costs go up, but the services continue to go down, or you end up spending a lot of time and the accountability piece, like you have your team, your crew that comes, and then your manager feels like they have to walk the entire community just to identify some of those issues and concerns. And so, landscaping, trash, and trash is, they're smart. They're building in like 10% caps year over year on these 3-year contracts. So we actually know day one that in 3 years we could be paying 30% more for that.
So
which
no matter
is
what,
huge.
no matter what.
No matter, well, if they want to and or need to. In a competitive landscape, I suppose, but they've locked us in for 3 years, and we've said, and they're trying to put in higher increases than that. But they're also anticipating fuel increase. They are. I understand a portion of it, but I wanted to paint that picture for everyone, so that way there's an understanding of what we actually already know and have known was going to go up.
Well, and that's another thing too, is not just, managing the things that you're paying for, but kind of like the services and the vendors that you're pursuing. And like, if you only know one guy and that person or that organization has a much higher price and you don't, then that's wasted money. And also like following up at how much you have to educate. And what if you pay so much for a landscaper and all they do is dump mulch and go away?
Story.
Yeah. But you
sounds like you've been listening.
Yeah. I listen to some discussions.
The leverage. It's. I think the hardest or the most painful part is like, what leverage do I have? And that's where, as operators, the smartest thing for us to do is to utilize whatever volume that we have as leverage and make sure that we're not, piecemealing and using all these different vendors, because, at that point there's no volume benefit that there's no leverage benefit.
Yeah.
So
that's a good
smartest
point.
thing we can
That's
do
a really good point.
Yeah.
So if you do shop around, you risk like it could, even if they had a great reputation, that there's less of an incentive to then that's really cool.
I've
That's
had
interesting.
communities in like tertiary markets before where, and landscaping is a great example actually, where, we couldn't get anyone to service those unless they were doing the bulk, in a major market.
Yeah.
So, it ends up being, we're sort of handcuffed, if you will.
Yeah.
But if we're a great partner with them and if they're a great partner with us, it can be a win-win. I don't want it to sound completely negative, but that is an area where operators can look at and even turn vendors and just say, how can I get you the appropriate volume and, volume of communities and volume that it makes sense to keep those, costs down. And that can be difficult in balance with, maybe wanting to do some work in-house. Because as soon as you start doing in-house paints, you take away that from the contract painter. And then they don't really want to give you that great pricing anymore because they're not getting the volume. And so we're just trying to navigate in this like perfect middle space.
Yeah, what can you do ourselves and what? Yeah. That's a really good point. I wondered, I saw this is a strange specific, but I saw these security cameras that are sitting on a desk.
Yeah, I saw those too.
And I thought I overheard a discussion. No, this was a discussion in our company. We were wondering whether to pay an outside organization to set up security cameras. They charge so much.
Yes.
And then, but security cameras, if you buy them online, if you do it the right way, if you do it yourself, maybe it's $50 a pop. But I am almost positive there's something else that you need to do that those $50 pop cameras are not going to cut it. So there are some things where you maybe try, and who knows, maybe that's just an assumption of mine. And we have got a great, we figured it out. But I feel like there is, you may get into it and say, oh, I could just go off the shelf. I have this great solution. And this kind of business-centered vendor is upcharging because we're big and they want to fleece us. But I think that there's also like considerations that maybe we don't know. There are always, and that's what the price is
on your objective. In the situation with camera, is my objective actual like risk mitigation? Is it liability mitigation? Is it that, if I'm going to have something big happen on my community, I want to be able to prove one way or another if we were negligent or as I was negligent. If you're looking at it like big picture like that, then you would go with a more robust solution because you have those options. If you actually have a problem with crime, our on-site team members are not trained necessarily to always be able to identify, nor can they sit there by the camera.
That's not.
I think that always boils down to just, why do you want it or need it?
That's a really good point. Yeah, if you get it in, then you're the one that's watching the cameras.
Right. Am I just trying to see if my site staff is there every day? That's, you can put other practices in place, maybe like biometric time clocks or something like that to have the same material effect, if that's what it's for. So you have to ask yourself, is it for monitoring and accountability? Is it for risk mitigation? And then that will drive your decision making.
Okay. Do you see, so have you gone through like a service that does these cameras or is like secure, and that's okay. So you learned, maybe not learned the hard way, but you I'm sure that you know that it makes sense, really, is what.
There are absolutely situations where it makes sense, but it always, even that, and they're going to hate me for saying this, but I mean, it's what it is. Like it's about the difference between, security or the illusion of security. It's the difference between did I just prove that someone did not slip and fall on my site, and now I don't have this insurance claim for these major medical expenses? I haven't had it in place.
It's not the illusion of security, it's atmosphere.
Okay. I liked that.
That's a true atmosphere.
Atmosphere.
Yeah.
Atmosphere.
That's interesting though, because that's true. If you don't need, if you're not like trying to address it as they happen, if from a liability standpoint, maybe you can get off the shelf and just record and then refer back to it. Yeah. And I was also thinking things like, maintaining them. Are these all weather units? What if someone damages them? Or, I'm sure if you're paying a service, they'll go out and replace them probably.
Yeah. And they tell you when they're not working. They tell you when they have blockage. They tell you when you have, light concerns, which are also safety concerns. So you're buying, that is labor alternative, right?
Yeah.
Perfect example of this is what I'm buying. And this is a labor alternative because otherwise my in-house team would have to, monitor some of those things or do more light checks or, whatever.
Yeah, that is that. I think that's just an example, but it kind of encapsulates a lot of things. In a lot what we were saying about like landscaping or really even like snow shoveling, it seems to be so much of it is a decision of like, are my people going to do it? Am I going to hire someone else? And I think there are cases where, it's 6 of one, half dozen of the other, but there's another one where like, no, this guy can do it much easier, much cheaper, and they're charging me a lot because it's actually more expensive than what I thought. But
and even I'm sure decisions come down to and I hate that this is how it always is. Let's get down to what happens when it goes wrong.
Yeah.
You have to be able to prove that you reasonably did, because people have fallen on city sidewalks.
Well, and that's what I was going to say. It's like all of these decisions are hard won. Yeah.
Yeah, they are. But you can ask yourself if they're always sort of based on risk. And it's like, I'm not saying do the bare minimum, but I'm absolutely saying like, what are our responsibilities and what are we able to do? I'm not able to get rid of every piece of ice in an ice storm with 4 days of sub-zero temperatures. It's impossible.
Yeah.
So on snow removal, we have to talk about and balance, what is our labor force able to do? But I can tell you for sure, when you hire that out, nothing, money flies off the shelf.
Oh yeah, I'm sure.
Removal and salt when you hire contractors.
I think there was one. It was a couple years ago where it was like an exceptionally mild winter, and we were all bracing for like the sudden winter storm.
Oh yeah, I read the Farmer's Almanac.
Yeah, that's
why we do the budgets.
Exactly. Yeah, it's hard to predict the weather. Oh man. So moving from kind of the expense side to the leasing side.
Yeah.
Now there's this article from RealPage last week that talks about how leasing traffic has begun to normalize. And it is, I think that was a lot of actually what I was talking with Addison about, is whether it's the economy or the apartment market. It seems like, things aren't going hugely amazing like they were in 2022 or 2021, but it's not like horrible. I think the expenses are up, and that's like really difficult, but I don't know. It just seems like rent growth, if you look on an annual basis, it's not great, but I think things are improving. And I was very curious to see what your impressions were on the ground, and what the impressions of, some of the property managers you've talked to are, what are they thinking? Are they saying like, listen, it's crickets here, or are people coming through the door?
I think, like, to your point though, are we in a panic because we're not making 16% each lease trade out? Are we making 6%?
Yeah.
Whereas there were years pre-COVID for sure that some operators were just putting 3% and 4% in their budgets, and they were just getting that year over year over year. And they were like, yeah, this is good. This is great. So you get a taste of it. you tried your first fillet, if you will,
Yeah.
and it's like now nothing else is sufficient. But like,
Yeah, I want to eat that every
you can
day.
still eat some steak,
Yeah,
and and it's going to be okay. I'm seeing the same, in terms of seasonality, seeing pretty much the same behavior. And the hardest part about that is that, there's this sort of like macro and micro view of it. Someone might want to say, well, in the Midwest or in Indiana, but
Yeah,
the
that's a
reality
really good
is
point.
there's a really granular seasonality. So, you might have a site that is in, their typical leasing cycle includes like an influx in December because they get January new hires at a particular business. Well, that's gonna be outside of what these seasonal norms are, but
Totally.
it's inside the market norm, like the in a very, I guess, individualized space. And so some of these I think are a self-fulfilling prophecy, right? So it's like years and years ago, like maybe you had a lease up, for example, that happened 3 or 4 years ago.
Yeah.
And you had to fill units quickly, especially on like a mid-rise, right? You might get 45 units at one time. So you lease 45 units at one time. And if you're not staggering those expirations, you are, it is a self-fulfilling prophecy. This is when my lease expirations happen. This is my retention goal. This is what I have to lease. And now I have availability to do it. So availability is always going to actually be like what dictates it one way or another. And so when you have a leasing cycle, yes, once they're stabilized and normalized, higher in the spring all the way to the early fall, and then we take a break because people don't enjoy moving in the winter.
Yeah.
And another site might stop their traffic at school time. And that's changed over 20 years. We used to go back to school end of August. Now, I know my daughter started end of July last couple of years. And so, there are certainly some properties that probably now see a drop off faster than they used to. Because if they have larger apartments and a high family demographic, they don't want to move during the school year if they can help it. And that perpetuates the cycle because that's when your expirations are high if you're not controlling that and leveling that out.
So apart from the kind of maybe the geographic or market specific or really like, neighborhood specific
sometimes
variation in leasing traffic, if it, for apartments that are in the same, if it was like a same location, have you seen a major difference this summer than like, are things looking promising either from like a historical standpoint? Well, I mean, it's not last summer, but are you worried basically when it comes to don't say yes.
I'm never worried.
Yeah.
Because we've handled some of these things before. It's just about how to maneuver. If I had a worry, I would say that it is in that, the housing that's not affordable, supposed to be attainable. We got all this rent growth and it was really exciting. And then now we see high delinquency, high vulnerability
for higher for like Class A.
No, not Class A. Class A doesn't particularly worry me.
Okay.
Except that that's always going to be where your new competitors come in.
So for like the low, like maybe like Class B or around that. Okay.
Yes. I'm talking about where the household doesn't qualify for affordable housing.
They're on the line.
Affordable housing. So they're in, what is supposed to be attainable for a workforce demographic. But because we've increased those rents and then because we've added other income to it, we didn't have valet trash a decade ago. Every property, pest control, package acceptance, some of these things that, maybe have started, like we're kind of filtering down.
Is valet trash, you leave it at your door and they take it away?
Yes, they do. I mean, it is a wonderful service. Please don't misunderstand that. And I
go and put it in the garbage can.
Yeah. And I think the Harvard study was talking about, that threshold of what people are spending on their housing. And if they're over 50% on their housing, and we have this like rent price, but then we have these other income prices as well. I'm not saying that we got greedy. I'm saying that we were aggressive at a time where it absolutely made sense to be aggressive. But if you did that and you're in those contracts, you're stuck. We're all stuck. We're all stuck. And so,
and especially the renters, there is especially
the renters,
there's much harder ceiling, I think, in terms of people's capability to pay. And I don't know how wage growth has been, but it makes a whole lot more sense for them to hit that limit and they just can't support further for their rent growth. They can't pay.
They just can't, and they can't pay. And so what we're seeing then is the higher delinquency, the higher eviction vulnerability. And, there was a time where there was no programs available. And now we, at least here in Indiana, have, some opportunity for recovery, but we don't have full recovery. And, just people in that area where, paycheck to paycheck. And then continuing to increase and then coming back for renewals and saying, well, we're not going to get 20% this year, but we are going to still ask you for 6 or 8%. And also doing that when your groceries are higher. Also doing that when higher.
For sure.
Even my oil change, I jokingly said to my daughter went to go get her first oil change by herself. She comes back and she's like, Mom, that was expensive. And I'm like, yeah, it was, but she was smart enough to use a coupon. Love that kid.
All right, good. She can stay.
Yes.
That I think that it's what I'm curious about, and this is one of the questions, is I was wondering kind of how you. Now I know that there are programs that say here's when you raise the rent, when you lower the rent, and you kind of follow the rules. But what kind of logic are the programs working on? And before the age of these programs, what signals did you take in? And I don't know, maybe delinquencies are one of them. But I was always thinking of less people come in, you lower rent, still more people come in. Now, so what are those things what are the triggers that lead you either to bump rents up or to lower them?
Yeah, I think, when I started, which is a long time ago, you did sort of just use that key occupancy number as okay, look how we're doing. We would use our lease expirations as an indicator also, but we never talked about it the way we talk about it now. We never said to ourselves, okay, what's my, in that 60 to 90 day range, what's the expiration look like? What's my retention rate been? What's my trade out? What's my turn cost? And how far can I go? And how many do I want to turn over? And I think that's the different language that really happened over the last, maybe even 4 or 5 years, where you started to stop saying, keep everybody, retain as much as possible. And you started to say, no, my opportunity for growth is in that turn. And what's that balance look like? How many do I want to move out? Instead of, oh my gosh, can we make sure that everyone stays? But the platforms, optimization platforms are so complex. And I certainly do my best in there, and I feel like I know a lot. And there are some times where I'm just like, okay, but that doesn't make sense. And part of the issue,
your job is for,
right? If you have a site using that's had 10 years of data in there, and then you have this strange last couple of years, and that's where you have to just keep your finger on the pulse and understand and know, well, okay, yes, I know you want to push my rents because I know that you see. The system in theory sees that we've got 12% of our leases expiring, and they expect us to retain all of those because we've retained all of those last year. Well, last year, nobody had anywhere to go. Yeah. They didn't have an option. They definitely didn't have a cheaper option.
Yeah.
Is that different? Is that different today? So it really just becomes where, as a human, you look at the data, but you have to remember what was going on. You have to look at the conditions that a system didn't understand. You have to understand, is Kokomo getting a brand new plant that's going to bring in jobs?
Yeah.
Then I know that I can push that because I have that opportunity and I have that demand coming. Does the system know there's a plant being sold or the plant coming in? I don't know.
That's interesting. Yeah, for sure.
Is there somewhere that we tell it, by the way, based on 2,000 jobs at this income level, how many of them should we expect to disperse throughout the market, and then how do we price that? I'm not sure if that. I don't know.
Tree falls on the fence makes it look a little ugly. People come in. I know that's a random thing, but there are so many. You can't capture every single element that goes into people's decision making.
Yeah,
I think that's why probably people talk to leasing agents and not robots or online. There's a lot of questions, a lot of things you got to draw on. Another question I had, it's not on my pre-program interview question, is what is the percentage of renters that go on to renew, and how much has it changed over the past 5 years when you're talking about how things have changed, where now people are maybe more comfortable with that unknown of getting a new renter at an increased rent versus getting renewal. So what's the percentage you've rented 1 year, or you've rented, you're an existing renter, you're going to renew or not, your lease is expiring, what's the odds that they are going to renew?
Yeah. So I've had sites that and some of this is demographic related, of course, like you're going to have more transiency in, is that a word?
Yeah, sure.
Thank you. It's going to certainly be, more transient in certain locations. And so I've seen properties turn over consistently 60%. So they're only keeping 40%. But that's not painful when you're growing rents, and in that particular case or that submarket, people were buying out of their leases constantly because of a major employer there that would bring people in. Yeah. And then they would maybe, transfer them to a different location, and we'd make a lot of money off termination fees. So like we were okay with the turn cost because the turn cost was coupled with termination fees and then higher rents as well. So that was a site that, we really only planned on keeping 40% of those renewals year over year, but we weren't mad about it because it was great. There are other sites that we could consistently plan on 60% staying. So like in Kokomo, Indiana, for example, it's just a little submarket north of Indianapolis, but great performer, in that 60% range consistently. And that really hasn't waffled. That hasn't changed that much.
It still seems, and I would think that, I don't know why, but I would think it'd be higher to have.
That we keep? You think
that you keep that it'd be around like 70 or something? Because if I'm in an apartment and nothing's really changed, why would I want to move around now?
You have to ask yourself, just like in terms of humankind, what are the conditions in which we become a renter, and what are the conditions in which we make a change? We get a lot of divorcees. Jokingly, we used to do outreach marketing to attorneys in January because people file the most divorces in January, so you could get a bunch of leases from the attorney's office. And if you look at human behavior and activity, 70% would probably could occur at a community that had a demographic that didn't typically have major life changes anymore.
Okay. And that makes sense too, because especially if you're talking about like younger renters that are maybe just entering in a new job, or if it's just
less possessions, less responsibilities, like pets, kids, things, you know what I mean? We buy furniture that we're totally happy with just like throwing away or reselling for $20. And that's different. And that's different today, but also it's just easier to pick up and move. So
when I moved I rented a house, but when I moved from the apartment to the house, that was a much easier move than moving from a house to another house. Took a little more.
It's horrible. Moving is such a painful process.
Yeah, that's why. That's another thing.
You have some of those residents that live there 3 and 4 and 5 years, and I'm not saying that you would do anything differently necessarily. Those are the ones that you can count on staying. Like you can talk to any property manager in the country, and they'll give you a handful of residents that are like, oh yeah, they're never going.
Okay, yeah, don't take advantage of them.
Right,
that's
but
nice to have.
Percent would be that would be really high retention.
Yeah,
and those would be communities that have sort of a niche demographic that for whatever those variables aren't moving on.
Yeah. So just kind of to sum this up, is there are there anything that when it comes to traffic that would really cause you worry? Now, traffic, I think that there are a lot of positive signs, but what are there any, what would be something for people to kind of keep watch on, or when you get worried about something? Now, I don't know when peak renter season is either, but is there anything that would kind of give you pause over just based on what your experience is?
Yeah, I think, if we were hitting the springtime, which even if those prospects aren't moving until, the end of summer, if they're just starting their search, if it was springtime and our numbers were flat, like, compared to February and March, like if there wasn't an uptick around that time, I would start asking questions about marketing. I would start asking questions about my reputation. I would definitely start saying, what's happening here? And then I would look year over year and just make sure that, that's not somehow consistent with that particular community. Yeah. But on a larger scale, if it's first week of April, unless we're still in ice storm territory, I would start to have some concerns, and I would look at my marketing. I would definitely look at my marketing first. I'd probably I'd phone a friend or two that has a community in my particular area, and just see if they are experiencing the same thing. And I'm more of a researcher, so I would immediately look at closures, hiring, building permits.
Yeah.
I would want to understand. What's available to everyone, especially to people in the, particular income range that we typically get. I would definitely look at a lot of those different factors and try to understand.
Yeah, totally.
Yeah.
And then the last question that I had that I pre-written here was about leasing traffic. Someone coming into the office.
Yes.
What is the chance that person is gonna buy, is gonna rent? Do you is that a figure that you guys follow?
So, yeah.
Because I know that they track leads.
Disclosure. I worry about our data at this point because at some point the industry, whether the industry has to define it or we have to define it, what's a tour?
Yeah.
What is this? Because right now I can actually see really low tour numbers and really high lease numbers. So either A, we're not reporting our tours as we should, or B, we just genuinely have that many people that either cannot or choose not to physically come to the apartment before they will make that purchase. Right.
Fine.
I mean, I remember my first leasing job.
Yeah.
They said you have to be at a 35% closing ratio. And so that number was, 10 tours, at least, 3.5 people. You get it. But 35% was that benchmark closing ratio. I was much higher. Always.
Okay, let's see. Yeah.
But, if we were to find a way to just say, at what point in the funnel do they become a ready, willing, and able buyer the way that they used to? Is it still 35?
Yeah.
It's still 35% and just a different kind of touch point?
With digital tours and stuff.
Yes.
And that's interesting.
I phoned a friend actually before that. Well, last week I was meeting with a well-known vendor, and they do, video software as a service. It's Real-Link. If I'm going to quote them, I probably should say their name. But so he gave me some analytics, and this is them doing some comparisons with actual leasing data. So it was 39% more likely to lease if they had watched one video. So to me, that feels very, very similar to this benchmark of if they came to view it, we should close 35%. So that to me says that it's still pretty close to that 35 or 40% in terms of what the expectation is for us to close on them. If they've made it that far down the funnel and they've put that much effort in, because people really don't like to put a lot of effort in, then we have to be in their top 2 or 3. Have to be in their top 2 or 3.
That's interesting. It's how everything changed. You can keep track in it's human, so there's bound to be mistakes, but you can at least keep track on a clipboard if someone comes in the office. But then, if they're going on your website and looking at your floor plans and looking and doing a virtual tour, how does that, tracking that's going to be really important, because otherwise that means maybe you spend money on a better virtual tour or or you redesign your website or something like. That is.
Yeah. Conversion used to be very much a human, that was a benchmark for the human, and not that it wasn't for marketing as well. I mean, I did work for a marketing company before, so I was on the other side working for an ILS. And, I remember coming into offices with leads reports, and they would say, well, we didn't get any leases off of your leads. And I'm like, try me.
Yeah.
But also then because of that, I would go in and listen to phone calls. I would see that, they weren't answering phone calls, or they weren't really selling on the phone. There's still a sales process.
Yeah.
So yes, absolutely need some really good tech. Really, really strong tech, because that's what we can control. I can control the message in any of that tech stack or in that nourishment. But I mean, at some point, they also just have to be a closer. You have to be a closer.
You still need the people there. Yeah, that's great. Thank you for coming. And this latter half was a lot more sharp, maybe than the prior half, but we'll leave that to the viewers. I really appreciate it, and it's getting me more excited for your upcoming podcast. Thanks again. And I think I'll end it here.
Okay.
Thanks.
Thanks.
Awesome.